Section 1. The Global Financial System, a network of intricacies. The global financial system is a vast and intricate web. It connects economies, businesses, and individuals worldwide. This interconnectedness, while fostering growth and innovation, also creates vulnerabilities. One of the most significant risks is the system's reliance on debt. Governments, corporations, and individuals have become increasingly reliant on borrowing to finance their activities. This debt-fueled system, while seemingly robust in times of stability, can quickly unravel during periods of stress. Furthermore, the financial system is characterized by complex instruments and trading mechanisms. Derivatives, for instance, are financial contracts that derive their value from an underlying asset. While intended to hedge risk, they can also amplify losses, creating a ripple effect throughout the system. The complexity of these instruments makes it difficult to assess risk accurately, potentially leading to miscalculations and market instability. The interconnected nature of the global financial system means that a shock in one part of the system can quickly transmit to others. This was evident during the 2008 financial crisis, where the collapse of the US housing market triggered a global recession. The crisis highlighted the systemic risks inherent in a highly interconnected financial system and the importance of understanding and managing these risks effectively. In conclusion, the current financial system, while facilitating global economic activity, is characterized by inherent vulnerabilities. Its reliance on debt, complex financial instruments, and interconnectedness creates a system susceptible to shocks and crises. Understanding these complexities is crucial to mitigating risks and ensuring the system's long-term stability. Section 2. Central banks and financial institutions, pillars of the system. At the heart of the global financial system lie central banks. These institutions play a pivotal role in maintaining economic stability. They control the money supply, set interest rates, and act as lenders of last resort during financial crises. Their actions influence borrowing costs, inflation rates, and overall economic activity. However, the effectiveness of central bank policies is often debated, particularly in the aftermath of unconventional monetary policies adopted after the 2008 crisis. Commercial banks and investment firms form another crucial pillar of the financial system. They act as intermediaries, connecting savers with borrowers and facilitating the flow of capital. These institutions provide loans to businesses and individuals, enabling economic growth and investment. However, they are also exposed to risks, such as loan defaults and liquidity shortages. Their stability is paramount to the functioning of the entire financial system. Stock markets, bond markets, and other financial markets play a critical role in facilitating capital allocation and investment. These markets allow businesses to raise capital by issuing stocks and bonds, while investors seek returns on their investments. However, these markets can also be prone to volatility and speculation, leading to asset bubbles and market crashes. The interconnectedness of these markets means that shocks can quickly transmit across borders, impacting global financial stability. Understanding the roles and functions of central banks, financial institutions, and financial markets is essential to comprehending the complexities of the global financial system. These institutions and markets are the backbone of the system, and their stability is crucial for sustained economic growth and prosperity. However, it is equally important to recognize the risks associated with their operations and the potential for systemic crises if these risks are not adequately managed. Section 1. The debt overhang, a looming threat. The global financial system is currently grappling with an unprecedented level of debt. Years of low interest rates, fueled by expansionary monetary policies, have encouraged governments, corporations, and individuals to borrow heavily. This accumulation of debt, while seemingly manageable during periods of economic growth, poses a significant risk to financial stability. As interest rates rise, servicing this debt becomes increasingly burdensome, potentially leading to defaults and a cascade of financial distress. One of the most concerning aspects of the current debt overhang is its sheer scale. Global debt, including government, corporate, and household debt, has reached unprecedented levels. This mountain of debt represents a significant vulnerability for the global economy. Any shock to the system, such as a sudden rise in interest rates or an economic downturn, could trigger a wave of defaults and a financial crisis. The easy money policies pursued by central banks in recent years have contributed significantly to the debt bubble. Low interest rates have made borrowing cheap, encouraging excessive risk-taking and fueling asset price inflation. While these policies were intended to stimulate economic growth after the 2008 financial crisis, they have also created long-term risks to financial stability. As central banks begin to unwind these unconventional monetary policies, the true cost of this debt will become apparent. Rising interest rates will increase debt servicing costs, putting pressure on borrowers and potentially leading to defaults. The longer this debt overhang persists, the greater the risk of a financial crisis becomes. Addressing this issue will require a delicate balancing act, as policymakers must navigate between supporting economic growth and mitigating financial risks. Section 2. Government Debt, a Balancing Act. Government debt represents a significant portion of the global debt overhang. Years of deficit spending, coupled with the economic fallout from the 2008 financial crisis and the COVID-19 pandemic, have pushed government debt levels to new heights. While some level of government debt is necessary to finance public services and stimulate economic growth, excessive debt levels can lead to a sovereign debt crisis. When a government's debt becomes unsustainable, it may face difficulty servicing its debt obligations, leading to a loss of investor confidence and a potential default. A sovereign debt crisis can have severe consequences for the affected country and the global financial system. It can trigger a currency crisis, capital flight, and a sharp economic downturn. The risk of a sovereign debt crisis is particularly acute in countries with weak economies, high levels of corruption, or political instability. However, even developed countries with strong economies are not immune to this risk. The European sovereign debt crisis of 2010 to 2012 demonstrated that even developed countries with sophisticated financial systems could face a sovereign debt crisis. Managing government debt is a delicate balancing act. Governments must find ways to reduce their debt levels while also promoting economic growth and providing essential public services. This requires fiscal discipline, structural reforms, and a commitment to long-term sustainability. Failure to address high levels of government debt could have severe consequences for financial stability and economic prosperity. Section 3. Corporate debt, fueling expansion, sowing instability. The corporate sector has also taken on a significant amount of debt in recent years. Low interest rates have encouraged corporations to borrow heavily, often to finance stock buybacks, mergers and acquisitions, and other financial engineering activities. While some corporate debt can be beneficial for investment and growth, excessive levels of debt can increase financial fragility and exacerbate economic downturns. One concern is the rise of zombie companies, firms that are able to service their debt but are unable to generate sufficient profits to invest in growth or innovation. These companies, kept afloat by low interest rates and lenient lending standards, represent a drag on economic productivity and a potential source of instability. Another risk associated with high levels of corporate debt is the potential for a wave of defaults during an economic downturn. As economic conditions deteriorate, corporate earnings decline, making it more difficult for companies to service their debt obligations. This can lead to a rise in defaults, which can spread throughout the financial system, impacting banks, investors, and the broader economy. The high levels of corporate debt present a significant risk to financial stability. As interest rates rise and economic growth slows, the ability of corporations to service their debt will be tested. a wave of corporate defaults could trigger a broader financial crisis, highlighting the importance of monitoring corporate debt levels and promoting responsible lending practices. Section 1. Asset bubbles, inflated expectations, imminent corrections. Asset bubbles, a recurring phenomenon in financial history, represent a significant threat to global financial stability. These bubbles occur when the price of an asset, such as stocks, real estate, or commodities, becomes detached from its intrinsic value, driven by speculative fervor and herd behavior. Investors, caught up in the excitement of rising prices, often ignore fundamental valuations, leading to a self-reinforcing cycle of buying and price inflation. This unsustainable trend eventually reverses, leaving investors with significant losses and potentially triggering a broader financial crisis. Identifying asset bubbles in real time can be challenging, as distinguishing between genuine growth and speculative excess is often difficult. However, certain warning signs, such as rapid price increases, high trading volumes, and excessive leverage, can indicate a potential bubble. Additionally, a disconnect between asset prices and underlying economic fundamentals, such as income growth or corporate earnings, can signal an overheated market. The consequences of asset bubbles bursting can be severe, both for individual investors and the broader economy. When a bubble bursts, asset prices plummet, wiping out investor savings and eroding confidence. This can lead to a sharp decline in consumer spending and investment, potentially triggering a recession. Furthermore, the collapse of asset bubbles can expose excessive risk-taking by financial institutions, leading to bank failures and a credit crunch. Preventing and mitigating the risks posed by asset bubbles is crucial for maintaining financial stability. Central banks and regulators play a vital role in this regard. By monitoring asset prices, identifying potential bubbles, and implementing macroprudential policies, such as loan-to-value ratios and capital requirements, they can curb excessive risk-taking and promote financial stability. Section 2. The Real Estate Conundrum, a House of Cards. Real estate, a significant asset class, has historically been prone to bubbles. The 2008 financial crisis, triggered by the collapse of the US housing bubble, serves as a stark reminder of the devastating consequences of unchecked real estate speculation. Factors such as low interest rates, lax lending standards, and government policies can contribute to the formation of real estate bubbles. In recent years, concerns have been raised about the potential for another real estate bubble, particularly in certain developed and emerging economies. Rapid price increases in major cities, fueled by low borrowing costs and speculative demand, have raised alarm bells. Additionally, the increasing prevalence of foreign buyers in certain real estate markets has further fueled concerns about a potential bubble. The risks associated with a real estate bubble are significant. A sharp decline in housing prices can lead to a negative wealth effect as homeowners feel less wealthy and reduce their spending. This can have a ripple effect throughout the economy, impacting consumer spending, construction activity, and overall economic growth. Additionally, a real estate crash can lead to a surge in mortgage defaults, potentially destabilizing the banking system. Addressing the risks posed by a potential real estate bubble requires a multifaceted approach. Central banks can raise interest rates to cool down the market, while regulators can tighten lending standards to prevent excessive borrowing. Governments can also implement policies such as property taxes and zoning regulations to curb speculation and promote affordability. Section 3. Cryptocurrencies, a decentralized mirage? Cryptocurrencies, a relatively new asset class, have garnered significant attention in recent years. Bitcoin, the first and most well-known cryptocurrency, has experienced dramatic price swings, attracting both enthusiastic investors and skeptical observers. Proponents of cryptocurrencies tout their potential to revolutionize the financial system, citing their decentralized nature, security features, and potential for financial inclusion. However, Cryptocurrencies also pose significant risks to financial stability. Their extreme price volatility, lack of regulation, and potential for illicit activities such as money laundering and terrorist financing have raised concerns among regulators and policymakers. Additionally, the environmental impact of cryptocurrency mining, particularly for energy-intensive cryptocurrencies like Bitcoin, has also come under scrutiny. The decentralized nature of cryptocurrencies, while a key feature for proponents, also presents challenges for regulation. Traditional financial regulations designed for centralized institutions may not be easily applicable to decentralized cryptocurrencies. This regulatory uncertainty creates risks for investors and the broader financial system. As the cryptocurrency market continues to evolve, regulators and policymakers face the challenge of balancing innovation with the need to protect investors and maintain financial stability. Striking the right balance will require a nuanced approach that fosters innovation while mitigating risks. This may involve developing new regulatory frameworks, enhancing international cooperation, and promoting financial literacy among investors. Section 1. Geopolitical fault lines. Tremors in the global market. The global financial system, once a beacon of interconnectedness, is increasingly vulnerable to geopolitical tensions. Disputes between nations, trade wars, and unexpected political events can send shockwaves through the interconnected web of financial markets. These tensions can erode investor confidence, disrupt trade flows, and destabilize currencies, ultimately impacting global economic growth. One of the most pressing geopolitical risks is the rise of protectionist policies. As countries turn inwards, erecting trade barriers and pursuing nationalist agendas, the free flow of goods and capital is disrupted. This can lead to higher prices for consumers, reduced profits for businesses, and slower economic growth overall. The uncertainty generated by these policies can also make investors wary, leading to market volatility and a flight to safety. Another significant risk stems from escalating conflicts and political instability. Armed conflicts, particularly those involving major economic powers, can severely disrupt global trade, displace populations, and trigger humanitarian crises. The resulting uncertainty and fear can lead to a sharp decline in investment, capital flight, and a slowdown in economic activity. In an increasingly interconnected world, geopolitical risks are not confined to national borders. A conflict in one part of the world can quickly spread, impacting financial markets and economies far away. The interconnectedness of the global financial system, while fostering growth and efficiency, also creates vulnerabilities, as shocks can be transmitted rapidly across borders, amplifying their impact. Section 2. Supply chain disruptions, a domino effect. The global supply chain, a complex network of interconnected businesses, transportation systems, and logistics, is vital for the smooth functioning of the global economy. Disruptions to this intricate web, whether caused by natural disasters, geopolitical events, or pandemics, can have far-reaching consequences, impacting production, distribution, and ultimately financial stability. Recent years have highlighted the fragility of global supply chains. The COVID-19 pandemic, for instance, exposed the risks of relying on single suppliers and just-in-time inventory management. As borders closed and factories shut down, businesses around the world faced shortages of raw materials, components, and finished goods, leading to production delays, higher prices, and lost revenue. Geopolitical tensions, such as trade wars and sanctions, can also disrupt supply chains. Tariffs and trade barriers can increase the cost of imported goods, while sanctions can restrict access to critical raw materials or technologies. These disruptions can force businesses to find alternative suppliers, often at a higher cost, impacting their profitability and competitiveness. The interconnected nature of global supply chains means that a disruption in one part of the world can quickly cascade, impacting businesses and economies far away. For example, a shortage of semiconductors, a critical component in many electronic devices, can impact industries ranging from automobiles to consumer electronics, leading to production delays and higher prices for consumers. Section 3. Technological upheaval, innovation, or dislocation. Technological advancements, while driving progress and efficiency, also pose challenges to the global financial system. Automation, artificial intelligence, and other emerging technologies, while promising increased productivity and innovation, also have the potential to disrupt labor markets, exacerbate inequality, and create new avenues for financial instability. One of the most significant concerns is the impact of automation on jobs. As machines and algorithms become increasingly sophisticated, they are capable of performing tasks previously done by humans, potentially leading to job displacement in various sectors. This displacement can result in unemployment, wage stagnation, and social unrest, impacting consumer spending and overall economic growth. While technological advancements create new opportunities, they also present challenges for regulators and policymakers. The rapid pace of innovation often outpaces the development of regulations, creating opportunities for regulatory arbitrage and potentially destabilizing financial markets. Furthermore, new technologies can create new avenues for financial crime. Cryptocurrencies, for instance, while offering potential benefits, have also been used for illicit activities, such as money laundering and ransomware attacks. Regulators face the challenge of fostering innovation, while also mitigating the risks posed by these new technologies. The impact of technological advancements on the global financial system is complex and multifaceted. While these technologies offer the potential for greater efficiency, innovation, and financial inclusion, they also present challenges related to job displacement, inequality, and financial stability. Addressing these challenges will require a proactive and adaptive approach from policymakers, regulators, and businesses alike. Section 1. The Gathering Storm. Climate change and financial instability. Climate change, once a distant threat, has emerged as a defining challenge of our time, casting a long shadow over the global financial system. The physical risks of climate change, such as extreme weather events and rising sea levels, threaten to disrupt economic activity, damage critical infrastructure, and displace populations. These risks, coupled with the transition risks associated with shifting to a low-carbon economy, pose significant challenges for investors, businesses, and policymakers alike. The financial implications of climate change are far-reaching, potentially impacting asset valuations, insurance premiums, credit ratings, and overall economic stability. As the frequency and severity of extreme weather events increase, businesses face greater risks of property damage, supply chain disruptions, and business interruptions. These risks can translate into financial losses, reduced profitability, and lower creditworthiness. The insurance industry, on the front lines of climate change, faces mounting challenges. As the costs of extreme weather events escalate, insurance companies are experiencing higher claims and may need to increase premiums, potentially making insurance unaffordable for some businesses and individuals. This could lead to underinsurance, exacerbating the financial impact of climate change. Central banks and financial regulators are increasingly recognizing climate change as a systemic risk to financial stability. They are beginning to incorporate climate risk assessments into their supervisory frameworks and stress tests, recognizing that the physical and transition risks of climate change could have cascading effects throughout the financial system. Section 2. Physical risks. Nature's toll on assets and infrastructure. The physical risks of climate change are already being felt around the world, with extreme weather events becoming more frequent and intense. Hurricanes, floods, wildfires, and droughts are causing widespread damage to property, infrastructure, and agricultural land, leading to significant economic losses and displacement of populations. Coastal communities and cities are particularly vulnerable to rising sea levels and storm surges. As sea levels rise, coastal properties face a greater risk of flooding and erosion, potentially leading to a decline in property values and insurance availability. Critical infrastructure, such as ports, power plants and transportation systems, also face risks from sea level rise and extreme weather events. The agricultural sector, heavily reliant on predictable weather patterns, is also highly susceptible to climate change. Droughts, floods, and extreme temperatures can devastate crops, leading to reduced yields, higher food prices, and food insecurity. These impacts can have ripple effects throughout the economy, impacting food processing, transportation, and retail sectors. The physical risks of climate change are not limited to specific geographic locations or sectors. The interconnected nature of the global economy means that a climate-related disaster in one part of the world can disrupt supply chains, impact commodity prices, and have cascading effects on businesses and financial markets globally. Section 3. Transition Risks. Navigating the shift to a low-carbon economy. As the world transitions to a low-carbon economy, businesses face a new set of risks and opportunities. Governments around the world are implementing policies such as carbon pricing and renewable energy targets to reduce greenhouse gas emissions and mitigate climate change. While these policies are essential for addressing climate change, they also create transition risks for businesses that fail to adapt. Companies in carbon-intensive industries such as fossil fuels, transportation, and manufacturing face significant transition risks. As governments implement stricter environmental regulations and consumers demand more sustainable products, these companies may face stranded assets, declining revenues, and increased operating costs if they fail to transition to cleaner technologies and business models. Investors are also becoming increasingly aware of the financial risks and opportunities associated with climate change. They are scrutinizing companies' environmental, social, and governance, or ESG, performance, including their carbon footprint, climate risk management strategies, and alignment with a low-carbon economy. Companies with poor ESG performance may face difficulty attracting investment, potentially impacting their growth prospects. The transition to a low-carbon economy presents both challenges and opportunities for the financial sector. Financial institutions need to assess and manage climate-related risks in their portfolios, while also identifying opportunities to finance the transition to a more sustainable economy. This includes investing in renewable energy, energy efficiency, and other climate-friendly technologies, and supporting businesses that are adapting to a low-carbon future. Section 1. Triggers of collapse. A cascade of failures. The global financial system, while seemingly robust during periods of stability, is inherently vulnerable to shocks and crises. These shocks can originate from various sources, including asset bubbles, geopolitical events, natural disasters, or even technological disruptions. When these shocks occur, they can trigger a cascade of failures, leading to a systemic crisis and potentially a total collapse of the financial system. One of the most significant risks to financial stability is the interconnectedness of financial institutions and markets. This interconnectedness, while fostering efficiency and innovation, also creates channels for shocks to spread rapidly throughout the system. A failure of one institution or market can quickly trigger a domino effect, leading to a loss of confidence, a freeze in credit markets, and a sharp contraction in economic activity. Another critical factor contributing to financial fragility is excessive leverage. When individuals, businesses, and financial institutions take on too much debt, they become highly vulnerable to even small changes in interest rates or asset prices. As debt levels rise, the risk of defaults and bankruptcies increases, potentially triggering a chain reaction throughout the financial system. The complexity of financial instruments and markets also adds to the vulnerability of the system. Derivatives, for instance, while designed to hedge risk, can also amplify losses, creating unexpected and potentially catastrophic consequences. The opacity of these instruments and the interconnectedness of financial institutions can make it difficult to assess risk accurately, potentially leading to miscalculations and market instability. At Section 2, Systemic Bank Runs, a crisis of confidence. Systemic bank runs, a nightmare scenario for any financial system, represent a rapid and widespread loss of confidence in the banking system. When depositors lose faith in a bank's ability to repay their deposits, they rush to withdraw their funds, leading to a liquidity crisis. If this crisis spreads to multiple banks, it can trigger a systemic bank run, potentially collapsing the entire banking system. Several factors can contribute to a loss of confidence in banks, including concerns about a bank's solvency, rumors of impending bank failures, or a general loss of confidence in the financial system. In the digital age, social media and online platforms can amplify these concerns, leading to a rapid and widespread panic. Once a systemic bank run begins, it can be challenging to contain. As depositors withdraw their funds en masse, banks face a shortage of liquidity, making it difficult to meet their obligations. This can lead to a freeze in lending as banks become reluctant to extend credit, further exacerbating the crisis. Central banks play a crucial role in preventing and mitigating systemic bank runs. As lenders of last resort, central banks can provide emergency liquidity to banks facing a run, preventing a cascade of failures. Additionally, deposit insurance schemes, which guarantee depositors' savings up to a certain limit, can help restore confidence in the banking system. However, the effectiveness of these measures depends on the credibility of the central bank and the government's ability to provide support. Sovereign debt defaults, a crisis of confidence. Sovereign debt defaults, once considered a rare occurrence, have become an increasing concern in the global financial system. When a government is unable or unwilling to repay its debt obligations, it can trigger a sovereign debt crisis, with far-reaching consequences for the affected country and the global economy. Several factors can contribute to a sovereign debt crisis. Excessive government borrowing, often fueled by political expediency or economic mismanagement, can lead to unsustainable debt levels. A sudden loss of investor confidence triggered by political instability or concerns about a country's economic prospects can also lead to a spike in borrowing costs, making it more difficult for governments to service their debt. The consequences of a sovereign debt default can be severe. The defaulting country may face a loss of access to international capital markets, making it difficult to finance essential services and investments. A sharp decline in the value of the country's currency can lead to higher inflation, eroding purchasing power and further weakening the economy. Moreover, sovereign debt defaults can have a contagion effect, spreading to other countries with similar economic vulnerabilities or high levels of interconnectedness. Investors fearing further defaults may withdraw their capital from emerging markets or countries with high debt levels, triggering a broader financial crisis. Market meltdown, a freefall into the abyss. A market meltdown, a nightmare scenario for investors and policymakers alike, is characterized by a sudden and catastrophic decline in asset prices across multiple markets. This freefall in market values can be triggered by a variety of factors, including a major economic shock, a loss of investor confidence, or a cascade of forced selling. One of the most common triggers of a market meltdown is a sudden and unexpected economic shock, such as a major natural disaster, a global pandemic, or a geopolitical crisis. These events can disrupt economic activity, create uncertainty, and trigger a flight to safety, as investors sell risky assets and move their capital to safer havens, such as government bonds or gold. Another contributing factor to a market meltdown is the interconnectedness of global financial markets. In today's highly interconnected world, a shock in one market can quickly spread to other markets, amplifying the initial shock and creating a domino effect. High-frequency trading algorithms, designed to execute trades rapidly based on market signals, can exacerbate this contagion effect, leading to a rapid and uncontrolled sell-off. The consequences of a market meltdown can be devastating for investors, businesses, and the global economy. As asset prices plummet, investors experience significant losses, eroding their wealth and confidence. Businesses face a credit crunch as banks become reluctant to lend and consumer spending declines, as households grapple with job losses and declining asset values. Averting catastrophe, a call for collective action. The global financial system, as we have explored, is a complex and interconnected web of institutions, markets, and actors, all operating within a dynamic and increasingly uncertain global landscape. While this system has facilitated unprecedented economic growth and prosperity, it is also characterized by inherent vulnerabilities and systemic risks that, if left unaddressed, could lead to a catastrophic financial meltdown. The potential triggers of such a crisis are numerous and interconnected. A sovereign debt crisis, a bursting asset bubble, a systemic bank run, a global pandemic, a cyber attack on critical financial infrastructure, or even escalating geopolitical tensions could set off a chain reaction, leading to a collapse of confidence, a freeze in credit markets, and a sharp contraction in economic activity. The consequences of such a crisis would be devastating, not only for the financial industry, but for the global economy as a whole. Businesses would face bankruptcies, unemployment would soar, and social unrest could erupt as the foundations of our interconnected world are shaken. The 2008 financial crisis, while severe, would pale in comparison to the devastation wrought by a total collapse of the global financial system. Averting such a catastrophe requires a collective and coordinated effort from policymakers, regulators, financial institutions, and individuals alike. We must acknowledge the systemic nature of the risks we face and work together to build a more resilient, sustainable, and equitable financial system that can withstand future shocks and serve the needs of all stakeholders. Towards a resilient future, building a more stable and equitable financial system. Building a more resilient financial system requires a multifaceted approach. Policymakers must resist the temptation of short-term fixes and instead focus on long-term solutions that address the root causes of financial instability. This includes implementing sound fiscal policies, reducing government debt, and promoting sustainable economic growth. Regulators must play a more proactive role in monitoring and mitigating systemic risks. This includes strengthening financial regulations, enhancing supervision of financial institutions, and promoting transparency in financial markets. International cooperation among regulators is also crucial to addressing the global nature of financial risks. Financial institutions must move away from short-term profit maximization and embrace a long-term perspective that considers the broader societal impact of their actions. This includes adopting responsible lending practices, managing risk prudently, and investing in technologies and business models that promote sustainability and inclusivity. Individuals too have a role to play in building a more resilient financial system. This includes making informed financial decisions, saving for the future, and demanding greater transparency and accountability from financial institutions and policymakers. The task before us is daunting, but not insurmountable. By embracing a spirit of cooperation, innovation, and long-term thinking, we can build a more resilient, sustainable, and equitable financial system that can withstand future shocks and support a more prosperous and just world for all.